Welcome to the Trestlebridge Capital Market Observations Call for Monday, October the 23rd. I'm your host, Eric Jefferson. Before we begin, I want to just offer our thoughts and prayers again to those directly involved in the current conflicts in the Middle East. Shifting gears, as we talk about capital markets, a lot going on in the world. I want to share a few updates with respect to everything on our radar. You saw there before we dive in, just a few quick words from our legal team. With that, kicking off a very busy week, going to hear from some of the mega cap tech names as they report their earnings, as well share their outlook for where they anticipate their respective businesses going forward with respect to growth and profitability. We talk about the impact that some of these magnificent seven or mega cap technology companies have. They've year to date through the end of September 30th accounted for 96% of the returns for the S&P index. If we think about the ability that they have to drive that, likely what we hear from these executives will dictate the next move for the S&P 500. Also, if you've not taken a look in some time, you can see that index has been under some pressure, down over 6.5% in the last 3 months. The average stock, though, if you look at the equal weight version of the S&P, down double digits, now negative on the course of the year, down roughly 1.5%. So again, we talk about everything that's taken place with respect to capital markets. It's been those mega cap names that have driven stocks higher. The question now, will the rest of the index catch up, or will you see some of those bigger names retreat, go back to their smaller cap counterparts? When we think about some of the sources of volatility as of late, as we've discussed for now, the last 24 months all comes back to interest rates. Similar to last year, we saw rates move higher. That negatively impacted both stocks and bonds. The only thing different this time around relative to last year is the catalyst for those rates to be moving higher. Last year, it was historically high inflation, and so the Fed was raising rates as a mechanism, as a tool to slow the economy and in turn curb inflation. Last week, we heard from Powell. They all but confirmed no additional rate hikes, at least for the short and intermediate term. Obviously kept that door open further down the road. The catalyst, though, today, a function of supply and demand. I think about some of the largest purchasers of U.S. Treasury debt. Those tend to be other central banks, China and Japan, as well as our Federal Reserve. Those three today not nearly doing as much buying as they have in the past for a number of reasons. Same thing, we think about regional banks not buying, interest rates, really a catalyst for that volatility earlier this year. And then lastly, if we think about our nation's balance sheet, what we spend relative to what we correct, that relationship has been going in the wrong direction for quite some time. Our House of Representatives still doesn't have a standing speaker. And so we think about some of the challenges curbing government spending relative to what it takes in. That likely will require the U.S. to either make some tough decisions around spending that would potentially slow our economy, or they're going to be forced to print more money that would have an inflationary result to it. And therefore, we think about investors that buy Treasury bonds. They are not as aggressively buying given those two considerations, which as a result is forcing prices to go lower and yields move higher. That movement in yields, again, had a very negative impact. Stocks down over 10%, bonds down over 5% in the last 3-month period. Now, from the seat I sit, we're approaching a period where peak yields, at least for the short to intermediate term, suggest that they are in, at least for now. In my opinion, that makes duration much more attractive. By duration, we talk about owning bonds that have elevated sensitivity to changes in rates. Again, if we don't anticipate rates moving meaningfully higher from here, you're now able to generate a much more attractive income owning some of those higher duration bonds as well. If we do have some stumbles, some increased volatility here, is a good chance you may see a snap down in yields, which would positively impact bond prices. So for those of you in a moderate portfolio that has some allocation to fixed income, I've seen we've recently reflected some of those changes just ever so modestly, increasing our duration profile. On the equity side, our positioning there still remains somewhat underweight risk, a function of leveraging some instruments that better protect should volatility ensue. As well, we have a very strong preference for those higher quality names, companies with stronger balance sheets, with stronger cash flow. The thought process being, if growth does slow, if interest rates don't drop and companies forced to refinance their debt at higher levels, it's those higher quality companies that likely will be better positioned to withstand what could be a challenging environment if we go there. That is certainly one a lot of the leading indicators suggest is very likely, which from where I sit, arguably the biggest disconnect in markets today. We think about the consumer, for example. Consumers, via the retail sales report last week, suggests consumer spending is still up, well above expectations, even despite the headwinds that we see from higher prices. However, we look at what suggests where we might be going further down the road. Defaults on credit cards, mortgages, and auto loans have exponentially ticked up for the last several months. That is also before we factor in student loan repayments resuming. So that's one. Today, consumers still going out and spending. However, if they're doing so by leveraging credit, that is a trade that ultimately will catch up, will have to be resolved. One that gives us a little pause when we think from a positioning standpoint for the time being. That's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.